Hello everyone, I'm Stephanie Basu. Today I want to introduce you to the world of accountancy by presenting to you the book of original entry called the Journal. Here, as you see, we shall first discuss the meaning of accounting and its importance to us and the world at large. Next, we shall also discuss the difference of bookkeeping and accountancy. Next, we will go into the classification of accounts and the golden rule of accounts, which we call the dual entry system. Lastly, we shall step into the study of the journal, because without having an idea of the above, it will be very difficult for you to understand the book of journal. So let's begin to understand the meaning of accounting. Accounting is the language of finance. It conveys the financial position of a firm or a business. A firm comes to know about its operations, its progress, its worth only through the financial statements. The financial statements prepared by a firm helps you and me to know the worth of the company, its progress of the company, its position among its competitors. Then only we will be able to decide whether we want to be shareholders of the company or whether we at all want to work in that company. It also helps to translate the working of a firm into tangible reports. Therefore, in a nutshell, we can say it records, summarizes, analyzes, reports data that concerns financial transactions. So it is very essential that we know the meaning of accounting. Let's get started. Now let me tell you a story. Two of my friends opened retail shops. Sarah opened a bookstore and Peter opened a grocery store. Peter was not a very organized person. However, he was keen on opening a grocery store, so his father allowed him to do so. He rented a place close by to his house. He purchased grocery worth rupees 3 lakhs but paid only rupees 2 lakhs to the vendor. After setting up the place, he opened his store. He was very excited. Customers, finding a new shop opened, started pouring in as usual. Customers started purchasing groceries from him worth 1 lakh and paid in cash. Some customers purchased groceries from him worth 50,000 on credit because they knew him. At the end of the month, he also needed to pay for electricity, for rent, for banners, and for tea coffee, which he had taken on credit. But he maintained no records, so he could not match his income and expenditure. Neither could he know his profit or loss. So one day I got a frantic call from him. He wanted help from me as I was an accountant. Sadly to say, I could do nothing for him as he maintained no records of his purchase, expenses, earnings, credits, etc. He was in a total mess. On the other hand, Sarah was well organized. She opened a bookstore by taking a place on rent. She purchased books worth 4 lakhs but paid only 2 lakhs to the vendor. Customers came and purchased books from her store worth 2 lakhs and paid in cash. Customers purchased books of 1 lakh on credit from her because they knew her. At the end of the month, she also had to pay electricity, rent, banners, and for tea coffee, which she had taken on credit. But Sarah kept a note of all the transactions she made in a diary. However, through these records, she was not able to make a financial report of the gains, losses, of the incomes, of the expenses, of the assets and of the liabilities of her business. Indirectly, she could not understand whether it was worthwhile having the store. So, she too gave me a call one day for help. I was able to help her because she maintained some kind of records. From those records, I was able to draw up the financial statement for her. From the financial statement, she was able to know her profit, her earnings, her assets, her liabilities, and so on and so forth. In this way, she came to know the direction of her progress and her business. Therefore, to sum up, why is accounting important to a business? Firstly, accounts helps to keep you organized. Secondly, it guides you on your decision making for the business. Thirdly, it helps you when you approach a bank or maybe a financial institution for loans to expand your business. Fourthly, it helps stock market to sell your shares better. Fifthly, it helps you measure your progress of the new strategies implemented in your business. Sixthly, it backs up your tax returns. Seventhly, it makes you accountable for your business. Last but not the least, without it, you are in trouble. Let us now run through the classification of accounts. Classification of accounts can be done in the traditional concept and also in the modern concept. In the traditional concept, as you can well see, accounts can be classified into two parts, personal and impersonal. Personal are accounts of persons like individuals, firms, companies, debtors, creditors. And impersonal are accounts not related to persons. For instance, machinery, rent, cash, etc. Personal accounts are further subclassified into three parts. That is, natural accounts, artificial accounts, and representative accounts. What are natural accounts? Natural accounts are related to people like Tom, Dick, Harry. Artificial accounts, on the other hand, are related to bodies personified like company, club, cooperative society. And what about the representative account? These are related to accounts which are representing certain persons or group of persons. Now, in the similar way, impersonal account is further subcategorized into two, that is, real and nominal. Now, what are real accounts? Real accounts are related to tangible and intangible assets. By tangible assets, we understand are assets which have physical existence, like land, building, machineries, etc. By intangible assets, we understand that they are those which do not have physical existence, like goodwill, trademark, computer software. Now, let us go to the nominal account. What are nominal accounts? Nominal accounts are related to expenses, losses, gains, and incomes. This takes us to the end of the traditional concept. Now let us go into the modern concept. What are modern concepts? Modern concepts are classified into 5 parts: assets, liabilities, capital, revenue, and expenses. Now, what are assets? Assets are property or legal rights owned by a company. They could be fixed assets, they could be tangible assets, intangible assets, current assets, liquid assets, or even fictitious assets. Now, what about liabilities? Liabilities are amounts which an enterprise owes to the owner or an outsider. Now, these liabilities could be internal liabilities. It could be external liabilities like current, fixed, or contingent. Now, coming to capital, what is capital? Capital accounts are proprietor or partner's account who invest money into the business. Now, coming to the revenue account. What are revenue accounts? Revenue accounts are accounts which are related to incomes and gains. And taking down to the expense account, what are expense account? It is very well understood. It is related to Now we are going to understand the golden rule of accounting called the double entry system. The most scientific and reliable method of accounting is the double entry system. In the double entry system, transactions have a dual aspect, and every transaction involves two parties, debtor and creditor, and the amount must be equal. One account gives the benefit and the other account receives it. This is what we mean by dual entity of transaction. Let us now understand the golden rule. First, we shall see how it applies to the traditional concept of accounting. In the traditional concept, we have 3 types of accounts, remember? Personal, real, nominal. In the personal account, the golden rule says that you should debit the receiver and credit the giver. That means for every personal account, if you got to debit the receiver and credit the giver. For every real account, you got to debit what comes into the business and you got to credit what goes out of the business. For every nominal account, you debit all expenses and losses and credit all incomes and gains of the business. This is very simple. Now, let me take you through the modern concept and how the golden rule applies there. As you have seen earlier, there are 5 types of accounts: asset account, liability account, capital account, revenue or income account, and expenses account. If the asset account increases, we debit the amount, and if the asset account decreases, we credit the amount. If the liability account decreases, we debit the amount, and if the liability account increases, we credit the amount. Similarly, if the capital account decreases, we debit the amount, and if the capital account increases, we credit the amount. Now, taking revenue and income account, if it decreases, we debit the account, and if it increases, we credit the account. Now, for expenses, if it increases, we debit the account, and if it decreases, we credit the account. This is the golden rule of accounting. And if you remember this rule, if you learn it by heart, then you will never go wrong in your accounting. At last, you are ready now to understand the concept of journal. What is journal? An accounting journal is a detailed account of all the financial transactions of a business. It's also known as the book of original entry. The entries of an accounting journal are used to create the general ledger, which is then used to create the financial statements of a business. The journal entries are usually recorded using the double entry method of bookkeeping. Each transaction is recorded in 2 columns, debit and credit. This helps us to reduce the possibility of an error, as at the end of a period, both the debit and the credit side should tally. Now have a look at the format of a journal. It has 5 columns: date, particulars, ledger folio, debit amount, credit amount. Under the date, what do we write? Date of the transaction. Under the particulars column, what do we write? Name of accounts, and then another thing is with a little narration, giving you an understanding of what the transaction is all about. Third column is the ledger folio. What it is? What does it mean? Number of the ledger book. Fourth column is the debit amount. That means the account that is debited, its amount is written in this column. And the account that is credited will be written in the 5th column, that is credit amount. Before we see an illustration, I just want to briefly take you through the rules of journalizing. First, we should ascertain the accounts that are affected by the transaction. Then we should ascertain the nature of the accounts affected, like personal, real, nominal. I hope you remember it all. Then we will apply the golden rule to the transaction. The rest, I think, you will understand it better with the help of an illustration. So let us proceed further. Now let us go through this example. John decided to start a fast food business because he lost his job due to COVID-19 crisis. Below are few of the transactions incurred by John to get a kickstart. Journalize the following. On 1st November 2020, John, in order to start the business, brought capital in cash, 2 lakhs. On the 2nd November 2020, he paid money into bank, 80,000. 3rd November 2020, he bought groceries for cash, 5,000. 6th November 2020, John bought goods, that is utensils, on credit from Mary, 30,000. 15th November 2020, John sold goods, that is food items, to customers for cash, 20,000. 18th November 2020, John sold goods on credit to his friend David, 20,000. On the 30th November 2020, John paid rent to the landlord, 6,000. And 30th November 2020, John paid salary to employees, that is 3 boys, 15,000. Now, let us journalize those transactions that we saw on the previous slide. I hope you remember the 5-column format. Date, particulars, ledger folio, debit amount, credit amount. Now, in the date column, as you can see, we have put down all the dates of the transaction. Whichever day you made the transaction, the dates are there put in the date column. Now, I'm going to concentrate more on the particular column for you. So, in the first transaction, you can see that John had brought money into the business as capital. So, the two accounts that are affected are cash account and capital account. So, cash account being a real account, cash is coming in, so we debit. And capital account being a personal account, John is the giver of cash, so we credit. Now, there are two things that you must remember in the particulars column to put. If you see the credit account, that is the capital account, there is a 2 before the capital account. This means that for every credit account or for every transaction that has a credit account, it has to be preceded by a 2. So cash account debit to capital account. And then you will see there is a narration. This is what you call a narration, which is given in bracket. It always begins with being the amount John brought in to the business as capital. Why do I write this? So that later on, maybe after 5 years, if I want to know what was that transaction for, if I see the narration, I come to know the reason for the transaction. So that's why we write a narration for every journal entry. Okay? Now coming to the ledger folio. It's very easy to understand. These are book numbers of the ledger. So cash book number, a ledger book for cash is book 1 and the ledger book for capital is book 3. Now we're coming to the debit column. If you see very clearly, the cash account debit, so the 2 lakhs is coming there in the debit column, and to capital account credit, 2 lakhs is coming in the credit column. Both debit and credit will have to feature the same number. Okay? Now let us go further to the next. If you remember, John had put in 80,000 into bank. So here again on the second, bank account being personal is the receiver, so bank is debited. Cash account being real, cash is going out, so it is credited. 80,000, and the narration that we write is being the amount paid into bank. On the third, John had brought some groceries. So therefore, purchase account is a nominal account, and therefore purchase is an expense, so we debit it. And cash account is again a real account and it is going out, so we credit it. And the narration that we write is being groceries purchased for cash. On the 6th, if you remember, he went and bought some utensils. But this time he did not buy it for cash. He bought it for credit from Mary. So you cannot put it to cash account. So whose account you have to put it to? Mary's account. So you have to open a ledger for Mary. Why? Because Mary is the one who has to get cash from you. So you may give Mary cash at the one time, or you may not give Mary cash one time. You may give it in small installments. So each time you give an installment, you have to note it down. So that is why you have opened a book for Mary, a ledger book for Mary, which I have numbered number 8. So now let's go into this transaction. Purchase account is a nominal account. So purchase is an expense. So we debit it. And to Mary account, which is a personal account, and Mary is the giver, so we credit her account. And what is the narration we write? Being goods purchased on credit from Mary. Clear? Now we go to the next transaction. In the next transaction, what was the transaction about? It was goods or food items sold to customers for cash. So cash is coming in. So what are the two types of account that are affected? Cash account and sales account, because you sold goods. So cash account is a real account. Cash is coming in, so it's debited. And sales account is a nominal account. And if sales is an income, so therefore we credit that amount. And what we write in the narration? Being goods sold to customers for cash. Now look at the next transaction. Here again, John sold goods to customers, but he sold it on credit. Who did he sell it to? David, his friend. So now, David, again, just like Mary, you opened a book for Mary, you have to open a book for David. Why? Because David may give you money, not in one shot, but may give you money in small installments. So you need to keep a track of it, right? So therefore, you open a ledger book for David. And that ledger book, I numbered it number 9. Okay? So, David being a personal account, David is the receiver, so you debit the amount. And sales being a nominal account, sales is an income, so you credit the amount. And what do you write in the narration? Being goods sold to David on credit. Correct? Now let's take the next account. The next transaction rather. What is the next transaction? Rent paid at the end of the month for the shop. Now, rent is a nominal account. So when rent is a nominal account and rent paying means it's an expense. So you debit the amount and what you pay it in the form of cash, right? So cash is the real account and it is going out. So therefore you credit cash account. Being, and then in the narration you write what? Being rent paid for the month of November 2020. Clear? Now, the last account for today is salaries paid to employees. Okay? So, salary account is a nominal account and salary is an expense. So, we debit the amount. And how do we pay salary? Not through kind, but we pay through cash. So, cash account is a real account and cash is going out from your business. So, therefore, cash is a credit. Cash is credited. So, therefore, what do you write in the narration? Being salaries paid to employees for the month of November 2020. Clear? So, particulars column I was concentrating on, and I have explained what is there in the particulars columns. Now, I just briefly take you through the ledger folio. As you can see very well, cash account is given number 1, capital account is given number 3, bank account is given number 2, cash account again given number 1. Then we go into number 4, which is purchase account. Then we go into number 5, which is sales account. Then we go into number 6, which is rent account. We go into number 7, which is salary account. And then we go into number 8, which is Mary's account. And we go into number 9, which is David's account. So there are 9 in this example. You find that there are 9 ledgers which are affected and 9 ledger book numbers are given in your ledger folio. So from the journal, it will be very easy to find out which ledger book this particular transaction is reflecting. You quickly open that ledger book and you will find the transaction. Clear? Now in the debit column and credit column, as you can very well see, we have put down the amounts related to the debit accounts and we have put down the amounts related to the credit account. And the last but not the least, to check that all your transactions are correct, what do? You total up the debit amount and you total up the credit amount at the end of the period. And you will see that both the debit amount and the credit amount is equal. That this means your journal entry is correct. This brings me to the end of my presentation. Now, what is your take for today? Just a few point outs. Let me read out. Bookkeeping is the recording of all the transactions of the business, but a journal is the recording of all the financial transactions of the business. All financial transactions follow the golden rule called the dual entry system. The totals of the debit and the credit column always must match. Nowadays, you have the automatic journals in the accounting software to save time. However, some organizations still maintain the manual journal for adjusting the entries and accurately recording the unique transactions. Have a good day. Bye-bye.